My name is Chinde Sakshi. Today's date is 29 August 2024. Today's topic is recession. What is recession? A recession is a significant, widespread, and prolonged the downturn in economic activity. A common rule of thumb is the two consecutive quarters of negative gross domestic product growth indicates of recession. The determines recession. Economics at the National Bureau of the Economic Research measure recessions by looking the non from the industrial production and retail sales. Other the LPER and the measure contribute information to the process or how they are the weighted in our decision. A downturn must be deep and the lasting quality of recession by the definition. The quality may not be evidenced when the downturn first being followed retroactively. The key takeaway recession is a significant and persistent decline in economic activity. The recession's length from the prior expansion of downstream through not recover to its the former peak for years. The 10 recessions, although some predicted recessions never materialized, the unemployment often remains high well to so early stages of the rebound can feel the continued recession of many. The uh, recession in Westphalia, Laura Porter, understanding the recession since the industrial revolution, most economic have the grown steadily, seeing few economic contributions still common between 1960 to 2007. The in recent years, recession have become the less frequent and shorter in duration. Decline in the economic output and the employment of recessions causes can become the self the perpetuating. For example, decline consumer demands and prompt to companies of staff, consumer spending power, and further weak consumer demands. Similarly, the bear markets that often accompany recession can result the wealth effect, suddenly making the people less wealth consumption. Since the Great Depression, governments around the world have to adopt the political prevention of the mini recession from the becoming far the 4 to 5. Some of these stabilizer factors are automation money into the pockets of employee. Other measures require specific action such as the cutting interest rate and simulation investment clearly identified after they are over. Additionally, investment economics employs that are experiencing the term of when recession is at its worst. The recession has the begin investment losses accumulate and the corporate the earning declines even if the measure of recession remain healthy such as consumer spending unemployment. The recession have after the economy hits the bottom of workers may perceive the recession as continuing for the years after the after the what is predict the recession while there is no single predictor of recession. The 10 US recessions since 1955 invested yield can be followed by the recession. 6. When the yield curve in normal, short term yield lower than the long term yield, because of longer term, for example, 10-year bond usually yield to year bond as an investor taking as the higher rate could be the bonds value before the yield goes over the creating an upward yield curve. The the rise of the near-term invested rates can the economy and the recession. The reasons for yield long-term bond drops that the short-term bonds and become the traders. Economy weakness leading to eventual the interest rate of it. And these include the ISM Purchasing Managers Index and Conference Board of Leading Economics Index composite of the indicator. The example at the example explain why the how economy goes to recession. These tortoise can be broadly categorized economic, financial, and combination of these factors. Some economists focused on the economic changes, including the structural shift in industries most important. For example, the sharp price and cost across the economy leading to recession. Some theoretics factors causes the recession, and the which says the recession are caused by insufficient growth in money supply is a good example of this type of theory. That's all about in that's all about recession. Thank you.